Hey guys, today's question comes from Dave in Santa Barbara, California. Dave asks, I've started a consulting business which will make some money this year. Do I need to make estimated tax payments? And if so, how do I calculate those payments? Well, thanks so much for the question, Dave. This is a very common question with new entrepreneurs and will continue to be an area of consideration for people with side hustles and the gig economy workers taking off. In this video, we'll address the following questions. First, what are estimated tax payments? Who needs to make estimated tax payments? When are estimated tax payments due? How to calculate estimated tax payments? How to submit estimated tax payments? And what happens if you don't make estimated tax payments? Let's jump into it. So first, let's look at what are estimated tax payments. So estimated tax payments are prepayments made to the IRS to cover your annual tax liability. There are two methods to calculate your estimated tax liability, which we'll cover here shortly. Most taxpayers earn their income as employees through W-2 jobs. If this is you, then you likely don't need to worry about estimated tax payments, and you can go ahead and stop this video. For the other self-employed individuals and investors, you'll need to make estimated tax payments throughout the year to avoid paying penalties and interest come tax day, April 15th. So who needs to make estimated tax payments? Estimated tax payments are for self-employed individuals, investors, and other taxpayers who have income that is not subject to withholdings. Now this includes sole proprietors, 1099 contractors, LLC members, S corporation shareholders, partners in partnerships, and individuals who receive passive income such as interest, dividends, and capital gains. Additionally, if you receive alimony or payments for gambling winnings, you may also be required to make estimated tax payments. Basically, if you receive any income that is not reported on your W-2, then you may be required to make estimated tax payments. If you're expected to owe more than $1,000 of tax with your filing, then you're required to make estimated tax payments. But hold up, there's one exception to the rule. You don't have to make estimated tax payments for the current year if you meet all three of the following requirements. First, you had no tax liability for the prior year. Second, you were a U.S. citizen or resident for the entire year. And three, your prior tax year covered a 12-month period. So when are estimated tax payments due? So estimated tax payments are due on a quarterly basis. So we divide the year into 4 even periods, and then the due date is the 15th of the following month ending that period. So here are the due dates for your quarterly estimated tax payments. So for Q1 payment period, which is January 1st through March 31st, that is due on April 15th. For Q2, which is April 1st through May 31st, that is due on June 15th. For Q3, which is June 1st through August 31st, that is due September 15th. And for Q4, which is September 1st through December 31st, that is due on the January 15th of the following tax year. Now keep in mind, if you do miss a due date or don't make a payment, don't worry. You can submit a payment at any time through the IRS's website, and the IRS will adjust any interest or penalties based on when the payments were submitted. If you know you're going to need to make these payments, I'd recommend putting these dates on your calendar to avoid having to pay any interest and penalties. Next, let's look at how to calculate estimated tax payments. Now here comes the tricky part. There are two methods to calculate estimated tax payments. First, you can pay in 110% of your prior year's tax liability, or you can pay in 90% of your current year tax liability. Let's look at an example to make this a little more clear. First, we will assume your prior year's tax was $100,000 and your current year tax liability is going to be estimated at $150,000. Let's look at the first safe harbor method using 110% of your prior year tax liability. So let's take 110% of $100,000, which equals $110,000. We divide that by 4, so you're making 4 even payments, and those payments are going to need to be $27,500. So on April 15th, June 15th, September 15th, and January 15th, you submit payments of $27,500 for a total of $110,000. Now on April 15th, you're going to owe the remainder of that tax liability of $40,000, so your total tax is going to equal $150,000. Now let's take a look at the second option, which is taking 90% of your current year tax liability. So now we know your current year tax liability is going to be $150,000. So 90% of that is going to be $135,000. We take that, divide it by 4, and you get your payment amount of $33,750. Again, we make those payments on April 15th, June 15th, September 15th, and January 15th for a total of $135,000. Now on April 15th of the following year, you still have a remaining tax liability of $15,000 that needs to be paid with your tax return to get to a total of $150,000. Now, as you can see with both methods, you end up paying the same amount of total tax, but the quarterly payments are significantly different. Next, let's look at how to submit payment. Submitting payment to the IRS is a fairly simple process. You can go online to the IRS's website at irs.gov/payments and submit your payments for free using your bank account paying through ACH, or you can pay with a credit card if you prefer, and you'll have to pay a fee. The other option is to mail a physical check with a payment voucher. I'll provide a link to the IRS's website in the video description below, where you can download your voucher template and submit the amount via check. If you do mail a check, you'll want to make it out to the U.S. Treasury and make sure you include your name, address, phone number, social security of the primary person on the tax return, and the tax year in which you're paying. There are different mailing centers depending on where you live, so check the IRS's website for the correct mailing address. Next, let's look at what happens if you don't make estimated tax payments. So if you decide not to make estimated tax payments, the IRS will likely send you a notice for the penalties and interest due. The IRS calculates the penalties based on 3 different factors. First, the amount of the underpayment. Next, the period when the underpayment was due and underpaid. Next, the interest rate for underpayments that the IRS published on their website on a quarterly basis. The IRS interest rate charged for underpayment is determined quarterly using the federal rate, the federal short-term rate plus 3%. So that's it, guys. Hope you enjoyed that video. If you learned something, please consider subscribing to the channel down below for more great accounting and tax content. We'll see you in the next video. We appreciate you watching. Take care.